All right, welcome to the last video of this mini series of Introduction to Managerial Accounting, and today I'm going to talk about manufacturing and service industries. What is the differences between these two types of industries when it comes to managerial accounting and utilization rates? So first of all, I know that in the past videos I spoke a lot about manufacturing, but when it comes especially to services, there's a couple of differences that is important for us to understand. Okay, so for example, manufacturing, they use materials, work in process, and finished goods inventory. But in terms of services, normally the inventories are very limited to the supplies you need. For example, a hotel will have inventories, yes, but typically they don't represent a big majority of the cost of their products. And therefore, it is important for us to understand as well that there are other services where maybe some of the inventories, you don't have all these inventories. Think, for example, of a restaurant. In a restaurant, you don't really have work in process because you're not going to have dishes that have been started preparing and then they're unfinished, for example. Another big difference is that the second big difference, manufacturing uses both product and period costs, but normally services, they only use period costs, unless it's a very specific type of service that offers some level of production on it. The third difference is that manufacturing uses cost of goods sold on the income statement, but services may use the cost of services on the income statement. So we adapt here the nomenclature, the number of the category, because it really doesn't make sense for the service to talk about the cost of goods sold. Another difference, okay, manufacturing requires a physical production site. But on the other hand, many services require more of a network that connects the service to the customer. And here, for example, we talk about the banking industry, we talk about, for example, telecommunications, entertainment, and so on. Another difference, manufacturing overhead is an indirect cost in manufacturing products, but overhead is an indirect cost incurred in serving customers. So what is the difference here? Manufacturing overhead in manufacturing is used to produce the product, but manufacturing overhead in services is, the definition is more about the fact that we use it to serve our customers. So it's a clear difference on this category there. Next one, in manufacturing, labor is a direct cost to products, while in service, labor is not a direct cost to products, but may be a direct cost to customers. And an example here, for example, is accountants in accounting firms or doctors in medical practices. They are a direct part of the service they provide to their clients, and therefore these categories that maybe in manufacturing would be indirect costs here are considered a direct cost. Finally, the last one is that in manufacturing, materials are a direct cost to product, while in services, materials are most often an indirect cost, but may be quite significant. For example, if you have fuel in transportation or utilities, in these cases, this would be a cost that is, yes, it's indirect, but it's very important for what you need to do the business. And those are the differences between manufacturing and services. The other thing I want to finish with is to talk about utilization rates. So utilization rates are basically measures that we use in services to analyze how a fixed asset in serving the customer is being used. And let's imagine here is the same thing as using full capacity, let's say. So high rates of utilization rates are very good because it means we're using most of the ability that we have to produce the service, while low rates are typically less good. Obviously, different service industries will have different names for utilization rate. They will also have different calculations that you can use. But one of the rates that is the most famous, the one used in hotel industries, and we call it has a specific name. We call it occupation rate, which basically tells us what percentage of rooms in the hotel is occupied at a certain point. So, for example, as an example, this occupation rate is calculated by having the number of guest nights divided by the available room nights. And here the number of guest nights is calculated as the number of guests in the hotel multiplied by the number of nights per visit, in other words per night period as well. And available room nights is the number of available rooms times the number of nights per time period. And typically in hotels, what we do is we consider that every room is just one person, kind of as a way to facilitate this calculation. So as an example, I put here this exercise. Let's assume that Easy Hotel is a single hotel with 100 rooms. And during the month of June, the hotel had 2,500 guests. Now, each of them stayed for a single night, just to simplify calculations, obviously. So to calculate the occupancy rate of the hotel, for example, we would have to do 2,500 guest nights divided by 100 rooms, multiplied by 30 days, because I have 100 rooms and I can sell them for 30 days, which is 3,000. And I would get an occupancy rate of 83%. As you can see, actually 83% is very good as an occupancy rate, but as you can see, this is a very simple calculation to do, and it allows us to know how much are we using the hotel to full efficiency. So to summarize, on this video we learned the differences between manufacturing businesses and services business, and we also learned that in service businesses typically we have a thing called utilization rates to understand how efficient we were selling the services of our business. Thank you very much. If you have any questions, leave a question below. And this is it for this mini series about Introduction to Managerial Accounting.